Good morning, ladies and gentlemen, and welcome to the show. Glad to have you guys here on this February the 10th, Friday. And thank God it's Friday. Anyway, let's get tuned in. Let's take a look at what's going on. First thing I want to show you is this chart here. Right here, this one. What I want you to notice about this chart, it's very hard to see these blue lines in here. Right here, there's another one. This goes all the way back to 1950. But what I wanted to really show you is these blue lines represent recessions. And you get them on a very periodical basis. What you notice here, we're way overdue for a recession. But not only that, is the jobless. This is the unemployment rate. And what you'll notice is every time just before a recession, the unemployment rate goes down very low. And then boom, the recession hits. This has got everything to do with the Fed and what they're doing with their policy making. And it's basically what I'm saying is going all the way back to the Great Depression. The Fed induced it. It's a cycle. It's repeated behavior over and over again. But keep this chart in mind, because right now the unemployment rate is, the real rate of unemployment is, of course, different from the rate that they show you. And those jobs numbers that just came out, I'm not going to ridicule them, but I'm going to say that I don't really believe that they're accurate. But this is something that the Fed really keeps their eye on, is these unemployment rates. And it's one of the things that we got to watch for when this cycle ends, because this is very important to what's going to happen to gold and silver very soon. And it's what we're waiting for. This movement up in gold and silver has been a long time suppressed. There's other geopolitical factors weighing in on it right now that I got to take into account. Now, I want to show you this chart right here. This is what I want you to notice about this. The Fed's balance sheet is what we're seeing in gray here with this blue line, is the Fed's balance sheet and how much money they're putting on their balance sheet, overlaid with the S&P 500. You see there's a direct correlation. Of course, this could be the Dow too, you know. Let's just call it the markets is lined in red, an overlay in red. You see, but you also see a little lag here. If we go back to the 2008 crisis right here, you see the Fed started printing right here at this little spot junction right here. And you see they printed for about, and the market kept falling even after they started printing. Roughly for a 6-month lag. That's a lag period, and you'll see that time and time again. So the Fed started to increase their exponential, the printer. They started the printer up, basically. But the markets didn't respond to that until 6 months later, roughly. And then the S&P takes off, again, 6 months. Now you see the same effect happening right here. The Fed went through a tightening cycle. You see them reducing their balance sheet right here. And the market started to fall off precipitously. It wasn't quite as long a period after the printing started. There's a massive print right here. This was, I believe, at the beginning of the COVID crisis. Right here, a massive print, and it responded within a very short period of time here. But that's unusual that it responds that quickly. But it depends on the size of the print. And this was a massive print, so that you see this massive surge in the market to correspond with the Fed's printing cycle. Well, you see what's happening right now. The market's dropping off as the Fed is going in through a very, very steep reduction in their printing. They're basically cutting off the spigots in the market. The market has responded, but not in a really massive move downwards yet, you know. So there's a lot of pressure right here. Now, what's the Fed going to do? Well, we got to watch the Fed when they reach the end of their tightening cycle, which is where they're getting right now. They're starting to get toward the end of their tightening cycle, and then they increase, and they come in, they respond to that. to move their balance sheet up again. And believe me, this is going to go up. I mean, they're almost, I'd say, almost to the end of this balance sheet reduction. And there's going to be a big increase in balance, because what's going to happen is we're going to get that response, or that bounce in the economy. We're going to get the recession that's ready to happen, and it's going to be a severe recession. And the Fed's going to respond, but then there's going to be this little lag effect that's going to occur. That's probably at least a month. Sometimes it can extend as much as 6 months before the markets respond to it. But, you know, one of the things I see here is this response time has gotten quicker. It's almost like, you know, say a guy, he's raising fish at a fish farm, you know. And the first time he throws the grain out to the fish, you know, from the feed, and they come in, they feed on the water. You ever see fish feeding? You know, they're a little bit slow coming. But after they get used to being fed like that, and he throws the grain on the water, the fish all rush in from wherever they are on the lake to feed on that. The feeding frenzy occurs. Well, that's the way the markets are getting. You can see this quicker response time from what happened in 2008. They didn't respond real quick. It took about 6 months. Here, you only see probably a very, very quick response. They're like the fish coming in to feed. So this response time in the markets will probably be quicker this time when the Fed goes back to because they're waiting for it. Like the fish are waiting for the grain to come in. And just a few things I wanted to show you guys. So the things we got to watch out for our big raise in precious metals. We're in a bearish cycle right now for precious metals. But how you know when this bearish cycle is going to end? And I mean, it could get a little bit more bearish as the markets start to turn downwards. And this is what I was talking about yesterday. But how we see the end of this cycle is several things you got to watch for. You know, you got to watch those jobs numbers. As the recession starts to bite and the jobs numbers turn over. You got to watch the Fed as they start to say, hey, you know what? We're reaching the end of this cycle. You got to watch for that. There's certain things you got to watch for that the Fed's going to turn directions, you know, and this is going to lead to the precious metals taking off this time again. Well, just like they have before, you know. I probably should have put the chart up from what happened back in 2008 with the precious metals. You know, we saw silver go all the way up to $50. And this was back when the dollar was worth a lot more. So the cost of production of silver back then was only like $6. Now it's almost triple that amount. Around triple that amount, the cost of production. So, I mean, just basic math, you just do the math. If it went up to $50 last time, well, it'd be triple that now to equal that. So it'd be like $150 silver, you know. So I'm just saying, you know, guys, you got to be patient, because we're running through this bearish cycle, and this cycle of the Fed trying to tighten. You can see from the top of their balance sheet right here to how far they've come down. It's at least equal to the last time they went through a tightening cycle already. And we've been through most of the pain now for the silver and gold market. And you know what? Still, even though we've been through all this pain, still silver is holding well above $20. You know, which is a good sign. Anyway, listen, guys, let's move in and take a look at the silver price today. $21.98 today. It's up 4 cents. We're all waiting for it. We're all waiting with bated breath to something that's going to happen later this year. Probably in the last quarter or the second quarter. The third quarter of this year. And that's the metals starting to break free again, you know, of this tightening cycle. But we're going to go through this bearish period, and what I'm saying to you guys is if the markets turn over in the initial stages, and this is what I was saying yesterday, we could see a drop in the metal price, a little bit lower than where we're at right now. But I doubt they're going to drop below mining production cost. And because of inflation, mining production cost has really went up. Everything for the miners now, it costs a lot more. Fuel prices have went up. Every time they have to go to the hardware store too, you know, and buy things. or buy from a wholesaler. And every time they go to purchase things to keep their mine operating, they're noticing a massive increase in price and everything, so they have to press that price on. And so their all-in cost of production of silver, right now is probably about $18. So, I mean, that's value. When you buy an ounce of silver, how many things do you buy does it cost to produce that big of a chunk of what you're paying for? In other words, the cost of production is that high. So, I mean, at $21.99, there's only a small margin for the miners right now at this point. It's dire that they don't take that margin away. So that puts a floor under the price of this product. And for a longest time, this has been money. And gold is starting to be money again. And silver is going to find its day, and it's going to be money again. You guys watch. Let's take a look at gold today. See what gold's running at. Gold is $18.56 today. Let's take a look at cryptocurrency for a second. And we're looking at a cryptocurrency price on Bitcoin. Where is my Bitcoin here? There it is, 21,657 today. And Ethereum is 1524. To a fall in the markets, this is much more of a speculative asset, and they're going to sell the speculative assets first if the market turns down. But in the longer term, you have to think about long term. As the dollar and the Western fiat currencies start to die in a hyperinflation, this stuff is so easy to transmit across the internet. And if you think about the way the financial system is, one of the biggest faults for gold and silver is that it exists in the real world as a real commodity you can hold in your hand. And why I say that's a fault is the way the modern economic system works. They want to do everything with a button push or a mouse click. And the fact that things exist only in cyberspace is actually a bonus to its being used in the financial system. A massive bonus. In other words, they can make a click of a mouse and they can send Bitcoin over the internet in its form of what it is. Where they can't do that with gold. You just can't click a mouse and have gold suddenly appear on your end of the screen and reach into the screen like the Willy Wonka movie, where the little kid travels across and he actually appears in the television screen. You can't do that with gold. At least not yet. Maybe they'll get the internet so you can do stuff like that, but not yet. And that is the way people like to do things nowadays, is they like to have instant gratification. They just go on their cell phone and they make a click and they've just bought something or sold something, and it's one and done. Where gold, they have to wait for delivery, and a real physical person has to deliver it, or a company has to move it, or it has to be actually moved physically across country, which is not instant gratification. We live in a generation of instant gratification, and that's where money moves. That's why big money managers and money funds and things like that, and if they're handling like tens of billions of dollars, how do you buy $10 billion worth of gold and take delivery? Well, you use a fleet of trucks, and then you got to think about storage and storage costs and all that kind of stuff, where they can buy and sell in the market, and it's all done with the click of a mouse or on their phone. Anyway, just saying, guys. But that's not going to stop gold and silver in the end. Because they're destroying the financial system, and this is the underlying asset that supports the financial system, gold and silver, it's not going to stop it in the end, because the desperation is going to make up for the fact that you have to take physical delivery. Because it's been money for like 7,000 years. Anyway, moving on, let's take a look at the The stock market today, it's S&P is down 4 points at 4076. The Dow Jones today is up 92 points at 33,792. What we're looking at with crude oil today is 79.90, and crude oil is up $1.84, which is quite a big jump. It's getting up near $80 again. Bonds and rates, we're looking at a mixed bag, but mostly rising yields, especially on the long end. The 10 years at 3.72, it's up 4.3 basis points, and the U.S. 30 years at 3.8. And here's another strong indicator of a coming recession is the fact that the yield curve is so much inverted. This means that they like short-term duration much better because they don't trust in the market. I mean, it's a factor that has always yielded a recession. There's so many recession indicators right now that are blinking red, you know. And this recession is going to have a lot of energy, and that energy is going to enter into the markets at a specified period in time, and we're going to see a rather large downturn in the markets. The market's going to go very bearish. And when that happens, the Fed is going to respond to it. And they're going to come into the rescue. Because they're almost toward the end of their tightening cycle anyway. Let's take a look at U.S. Well, that's when gold and silver is going to take off. Is when this tightening cycle is over. And it's been a long, depressing tightening cycle, hasn't it, guys? You know? It's been hard on investors. Hard on people. Where do you put your money? 103.56 for the U.S. dollar index. Thank you guys for listening to my show. Have a nice weekend, guys. I'll be on with a story on Sunday. And of the good old days, good old times. We really all enjoyed those good old times. And this world that we got now, moving into this computer age. Like I say, you know, there's a hurdle here we got to get over. And, you know, just like a hurdler in a race has to jump over hurdles, and if his toe catches on the hurdle, down he goes, and he goes down hard onto the pavement. He has to make sure he clears the hurdles, and that's the same way with us. There's a hurdle that we're clearing here, a technologically advanced hurdle, where we have to get past our old ways of thinking. And this is the problem, is we're going back to our old ways of thinking with these wars and stuff. We got to get past all that to get over the hurdle. Otherwise, we're going to fall flat on our face as a civilization. Thank you guys for listening. We'll catch you guys in the next show. Bye-bye.